This is a call to order of the regular meeting of the Personnel, Pension, and Insurance Committee of the MDC, Monday, August 26, 2024. Clerk, do we have a quorum?
Yes, we do. If I see Commissioners Lester and Mandyke on the WebEx. Are there any other, is there a commissioner that is called in on a phone number? Okay, we have a quorum anyways.
Are you counting Mandyke because she's not a member?
No, she's not.
Okay.
No, we have a quorum.
Okay. Do we have any public comments relative to agenda items? Once again, public comments relative to agenda items?
No.
There being none. Approval of meeting minutes of July 29th, 2024.
So moved.
So moved.
Do we have any deletions? Amendments? All those in favor?
Aye.
Aye.
Opposed? Any abstentions?
Abstain.
Okay. Item 4, consideration and potential action with regard to approval of Amazing Workplace for Employee Climate Survey.
Good afternoon, Kelly Shane, Chief Administrative Officer. I have on the phone today, again, at the committee's request, Sean Holyfield and Tim Stein. Sean is the CEO and founder of Amazing Workplace, and he was here to provide some more context. I think at the last PPNI meeting last month, you had requested to learn more about the categories of questions for the climate survey, or what Amazing Workplace calls the employee happiness survey. And more about those categories of questions and the meaning of them and why they use them. And so without further ado, I might turn this over. Sean, I believe you're on the WebEx. I'll turn the presentation over to you.
Perfect. Would it be possible to allow me to present?
I believe so.
Yes.
Excellent. Is everyone able to see my screen here?
Yes.
Okay, very good. So I know we have limited time. I'm going to walk through the topics which we see here on the left side. And these topics are here along the left side. They're numbered 1 through 10, as well as an overall happiness. And then very specifically how the questions and the information provides a really meaningful starting point for understanding how people feel and being able to then decide what action to take in order to affect change. Does that make sense?
Does anyone have any questions with regard to that?
Yeah,
Commissioner
thank you,
Salemi?
Chairman. So, yeah, in the list that we got of topics for use in surveys, you listed a number of things that I think are all sort of, pertinent in any kind of satisfaction survey, of employees. But I was also looking for, at the end, you said additional topics can be added or customized to meet your needs. So are we talking about the same thing when we're talking about the topics for the survey?
Yes.
Okay, all right. I just want to make sure I wasn't on, jumping to something that you hadn't gotten to yet. So, one of the examples that I gave when we first started talking about this was, we had, in the course of the last, not this past year, but the year before, we had signed some new agreements, new labor agreements. And in my experience in the past had been, and these were significant ones. We had sort of restructured some of the job descriptions recently with a multitasking thing, which I think everybody was happy with. I think the employees were as happy with it as management was, because it meant something to them as well. But just a way to go back and to see that those contracts were operating the way they should. I gave an example of something, not an MDC thing, but another thing where I was a negotiator on it. And both sides had forgotten something. We'd forgotten to put a sentence in a procedural thing. Both overlooked it. And signed the contracts and went on, and then all of a sudden this issue kept coming up, and both sides understood it a different way because we had forgotten the thing. So and my point was, I don't know if analyzing the operational satisfaction on both sides, with the labor contracts, is in one of these topics that's already here, or if that's something we would have to describe in a different way. So, and if I haven't described that situation well enough, I apologize, but I'm trying to tie it to an experience that I had. So go ahead.
Understood. You explained it in a very excellently, very, very well. The recommendation that I would have is that questions specific to an event or feedback that we want tied to a direct action would sit outside of these topics. So if there were an issue with those actions taken, we would probably see some of that surface either in comments or tied to specific topics that are covered. But very specifically, if there is a very direct question that we're wanting to get answered, that would be a separate question. Does that make sense?
It does, and but I wouldn't. It's not that the question has to be very specific. The question itself can be general, but it's just about a specific topic, which is the general satisfaction with the labor agreements and the procedures that they lay out and all that, and that those things are working right. And it doesn't mean everybody's happy with all the decisions that got made, but that everybody understands that it's not the agreement that's the issue. There's not a problem with the agreement. That's something else. That's sort of what I wanted to get at. So I thought there were good agreements this time. I thought they were good, and I just wanted to make sure that I was right about that. That's all.
Totally understood. Labor agreements is a great topic, as are job descriptions and other specific things. Labor agreements are not often something that are asked about in a customer satisfaction survey or a happiness survey, just because they occur once. Obviously, recently there's been some edits or adjustments made based on what's been shared, and it makes sense that we would kind of probably want to find out how folks felt about that experience. Having that as a question, again, added in underneath a either miscellaneous category underneath here, where we're just trying to get a very specific feeling or sentiment on how people felt about that experience, is completely able to be added here. Don't know that I'd recommend adding it to most of these. It could be added to the job, work, and career in terms of questions here. It could be very specifically, did you enjoy the labor agreement process, or any of those types of things, in order to get sentiment tied to that. The way that the questions are designed here is to roll up and to be very actionable for the topics that we're covering. If there's an appetite to change the labor agreements, then asking about how people feel about it and whether they would make an additional change and finding out that makes sense.
Well, let me just explain something. Both management and labor signed the agreement, so it's not like we're asking them, do you like this agreement? They signed it, so obviously they're satisfied with it. The point was to say, is it procedurally, is it working out okay, and that's not that the agreement and its procedures are not at issue, that it's okay. That's all I was looking for. So I'm sure you can find a way to handle that, or we can get a way to do that, and then
Mr. Curry?
Okay. Yeah.
Thank you, Mr. Chairman. Commissioner Curry. Hi, Sean. How are you today?
Really well. How are you?
Good, good. I just want to piggyback on Commissioner Salemi's question. Are there questions in the survey that deal with working conditions?
Yes.
Are there questions? No,
provided-
I like short answers. Yes is fine.
Yes.
Are there questions in there that deal with impact with supervisors?
Yes, absolutely.
Okay. And is there questions in there about their salaries and/or benefit package?
Yes, relative to similar size industry, the question is very specifically tied to, I'll actually pop this up.
And is there
Pay
any?
fair, yeah. for jobs.
Yes is fine, Sean.
Yeah.
Is there any questions in there about staffing levels?
What do you mean by that?
Well, you say, do you have enough people to do the job you're hired to do?
Oh, yes. Yes, there are. Yes.
Okay. All right. So, I think your responses to my questions answer a lot of concerns that Buddy might have as it relates to contracts, because those are the bulk of what contracts are all about. I guess one other question they have, is there any questions in there about, is there processes available to grieve or to raise questions with supervisors or management, and what the results are if you do?
Yes, as
Okay.
well as whether people feel safe bringing up those concerns.
Okay, so my final series of questions for you are, can you just reassure us, and I know at your last presentation, but can you reassure us that the responsibility from our end, MDC, is to provide you with, and these are broad-based general, so Kelly, don't jump at me, but we're going to give you the names of our employees, and you're going to reach out to them, and hopefully in big capital bold letters, you're going to advise them right up front that their responses are confidential and cannot be linked to their name. Once they complete the survey, it goes back to you and into your system, and then you present us with a final report on what your findings are.
Correct.
Okay? I'm done. Thank you.
Okay. Are there any other questions? There being none, may I have the appropriate motion?
Move adoption.
Second.
Any discussion, further discussion? All those in favor?
Aye.
Aye.
Opposed? Passes.
Good job.
Item 5.
Thank you.
Yes, thank you.
Thank you very much.
Thank you.
Appreciate it. Thank you. You were quite helpful. Dahab, you're on.
Great. Good afternoon, everybody. I believe everyone should have a hard copy of the two books. If not, we do have a couple of extra copies. So I'll start off with the thick book first. That is the pension plan, and I'll just highlight a couple of the economic statistics as I usually do at the beginning of the quarter. So if you turn to page 4 for me, in the upper left-hand corner of the page, those two columns represent some economic statistics for the prior quarter and the current quarter. As you know, this captures the second quarter. So this is April, May, June. And you'll notice that many of the lines are similar in the current quarter and the prior quarter. The first row did change. You see GDP, which is obviously gross domestic product, a measure of how the economy is doing. It came in at 2.8% for the most recent quarter. The takeaway is that the U.S. economy is still growing at a reasonable pace. Ironically, the long-term number, if you look at about a 50-year timeline, GDP is kind of right in that range at around 2.8, 2.9%. So we're plugging along quite well. Unemployment here, you see ticked up from 4.1 up to 4.1 from 3.8. After this, it did go up a little bit more to about 4.3%. The positive about it is that most of those people that got caught up in the higher unemployment rate are actually people that were unemployed looking for work now. So they're coming back into the roles of actually calculated as unemployed. Because if you're not actively looking for work, you're not an unemployed worker. So that's a positive because actually it gives a little bit more ammunition for the Fed potentially to decrease interest rates, which, as you may have all heard, they were at Jackson Hole recently, and they telegraphed pretty clearly that the direction of interest rates is on a downward trend again. So that's positive. So instead of where we're trading at today, short-term interest rates at about 5.25%, 5.5%, that probably will move down. The markets have actually already priced in 2% decrease within the next year and a half. Probably a little overly ambitious, but at least now it looks like the trend is going to be coming down, which is a good thing because, as I've mentioned in the past, the yield curve, which is just an expression of different treasury rates across different maturities, the yield curve is still inverted. And what that means is that short-term interest rates are higher than longer-term interest rates, which doesn't make sense, right? Because if you lend somebody money and they decide to hold on to that money longer, then they should owe you more money. Right now, we actually owe less money the longer you go out on the curve. So a normal expression would be that short-term interest rates should move down, the longer-term interest rates will stay where they are. Additional to that, CPI, which is a measure of inflation, that shows movement from 3.4 to 3%. It actually came down to 2.9%. So the Fed is looking at a couple things. Number one, we do have unemployment ticking up slightly, and we actually have inflation coming down slightly. Both of those are good things. So at least it does give them a little bit more latitude again to potentially decrease interest rates. The other thing I'll highlight for you on this page is if you look in the upper right-hand corner of the page, it still was a good, steady stock market, although there was a lot of noise in the quarter. And what I mean by that is the second row from the top, if you look at that column that says quarter, the S&P 500 returned 4.3%. So that is a reasonable number. In fact, if you look over the trailing 12 months, it's generated 25%. And again, that is a lot. Over the long term, I've mentioned this to you in the past, if we get anywhere in the neighborhood of about 9 to 10% in 1 year, that is a reasonable number. That's kind of what the long-term averages are. So seeing that we've gained about 25% over the trailing 12 months, it would come as no surprise at some point there will be a little bit of give back. I think we're going to have some volatility right now, but things despite what you have as exogenous events of multiple wars out there, despite what we just went through recently, I mean, if you look at our election cycle, you had an assassination attempt of one of the candidates, and you had one candidate drop out, replaced by another, and you have all the wars that are still happening. Despite that, the markets still are going up. But as I said, it was a little bit muddled because you notice the next two rows, the Russell Midcap and the Russell 2000, those are smaller stocks, and both of them were down a little bit. The NCREIF Odyssey, several rows down, is an expression of institutional quality real estate. That was off fractionally. So we are coming towards the tail end of that, which is good. And bonds were up fractionally, up 0.1%. So hands down for the trailing 12 months, the clear winner was large cap stocks. And then you can see that also in the bottom left-hand corner of the page, that square, we categorize that across growth, core value, and then large cap, mid cap, and small cap. And you see that large cap growth is the winner, up 8%, while almost everything else was down for the quarter. That trend just is continuous with you saw the trailing 12 months. Large cap growth was up 33%, more than triple what you saw from anything that was small cap. So it was really by a handful of stocks, and we've talked about this and you hear about it all the time. In fact, the earnings for one of those companies, which is NVIDIA, is going to be coming out soon. NVIDIA is the semiconductor company that basically is creator of all those chips that all the AI or artificial intelligence needs. So right now, you have a lot of that going up. The hope is that other sectors of the economy will also improve, and you have a rotation so that smaller capitalizations as well as value stocks pick up the pace a little bit. And that's all something that you've probably either read about or heard about. Generally speaking, as the market cycle rolls over and you go into more of a modest pace growth, that's kind of what you see. And it seems like we're pacing that way, which is a good thing, because actually that means even with volatility, the market, primarily stock market, can continue to rise. If you could flip for me a couple of slides to page 9. So this is a snapshot of the portfolio over different trailing periods. And the thing I'll say is that it was a very good quarter. In fact, the pension plan has experienced very good returns over the long term and the short term. And what do I mean by that? So if you look at the upper left-hand corner of the page, first column, quarter, the fund gained 1.5% on a gross of fee basis. And you're measuring that multiple ways. The public fund rank is how do we rank relative to other plans out there? The lower the number, the better. We're in the 29th percentile, so roughly the top third. The shadow index and policy index are just naive asset allocations using index funds. One is what the policy has, and one is the actual asset allocation that we have. So you replace all the managers and just put in index funds. That's what the return would have been. So our return of 1.5 outperformed the 0.8, 0.7, also outperformed about 70% of the funds out there. If you look over the longer term numbers, you see that 5 years, the fund gained 8%, and for the past decade, 8.1%. Both of those top third of the universe. Coming down the first column, the reason why we did so well, as you may remember, large cap and mid cap are index funds for us, which is why those numbers in gray match the benchmark below it. Small cap is an active manager, so we have Wellington there who actively decides to buy and sell stocks. They did their job because they lost less than the benchmark. They only lost 1.2%, while the benchmark lost 3.3%. That put them in the 24th percentile. Our international equity manager is also active. It's Hardman Johnston. They did very well. They generated almost 4%, while the benchmark was off fractionally, top decile. Real estate was down a little bit, down 1.6 to negative 0.4. For us, though, real estate as an allocation has done well over the long term, which I'll come back to. Timber did fine at positive 1.3 versus the bogey at 1.7. And then our fixed income, which is kind of middle of the fairway, conservative of 0.7 versus the bogey at 0.1. What I said regarding real estate and timber, as a reminder, for us, we look at them as proxies or substitutes for bond. So relative to bonds, over the trailing periods, have they done better? So if you look over the trailing 3 years and trailing 5 years for real estate, timber, and fixed income, for 3 years, real estate's up 1.8, timber's up 7.5, fixed income's only up 0.2. For 5 years, real estate's up 3.7, timber's up 5.4, domestic fixed income is up 2.4%. So they've done their job. This portfolio is not overly complex. It doesn't need to be. We have the majority of our equity exposure or stock exposure indexed, and the place that we have active equity exposure, it's because the managers earned their way there. They beat the benchmark above and beyond fees. Asset allocation, the upper right-hand corner of the page, just at a high level, if you draw a line right under international and you add up all those pieces, stocks come out to roughly two-thirds of the portfolio, and then everything else that's not stocks comes out to roughly one-third of the portfolio. So at a high level, roughly two-thirds stocks and then one-third not stocks. And then, of course, at the bottom of the page is just an expression of the market value. Our market value actually declined slightly, but that's just because we made more distributions. So this pension plan pays out roughly about $1.8, $1.9 million a month. So if we make anything around that, the corpus of the fund remains stable. If we make more than that, the corpus rises over time. Let me pause there, see if there are any questions before I jump on to a couple more slides. Yes?
Yeah, one very quick question. Do you need to examine or take a careful look at the level of withdrawals?
I'm sorry, the level of?
The level of withdrawals from the pension plan in terms of the monthly payments that we're making. Do we need to examine that and perhaps look at the policies and make some determination as to whether or not we should make changes, or should we just
So
steady as we are and move forward?
I think steady as we are and move forward is probably the best policy because the level of the draws is something that we can't change. It's whatever the participants are entitled to, the benefits that they have. It's the monthly payment, as well as some expenses. All that gets taken out. The way that we typically handle it is that the contribution is made towards the beginning part of the year. We have that as cash because that has been yielding a good number for us. And then we bring down cash as we pay off those benefits. Towards the tail end of the year, then we just pay, dwindle down some of the assets in order to have some cash to pay our benefits. So it's been a good balance.
Okay,
Mr. Chairman?
sorry, Mr.
Yeah,
Mr.
and just to
Salemi?
go, just to make sure I understood what you got. So under the investment return, first of all, it's basically only 3 months that we're looking at, right?
Sure,
We're
we
looking
could look at
from-
3
We're looking
months.
at from March to June.
Correct.
And so the market value has a negative change by like 1.2 or 1.3 something million. Am I correct about that? Market value as
The
of
market
June-
value declined by about $1.3 million because we paid out more money than we made.
Right, yeah, so, and that's exactly what you were just talking about, Mr. Chairman. So the withdrawals put together with the capital gains, the gains and losses showed a net of 1.3 million. So
Yep, yeah.
loss, yeah.
Yeah, so the portfolio's done fine, and it's doing what it's supposed to. You'll see that actually in the next picture. I think this is probably the easiest way to see it. If you look at page 11, and for those of you that have seen this picture before, it's just a reminder, but this is a pictorial depiction of the growth of the fund over these past, call it 20 years or so. And you see the dark line is the actual corpus of the fund. And the major takeaway is that it has grown, and it has grown nicely. So the beginning value there is about $121 million. And even though we've paid out $143 million during this entire period, because we made more than double what we started off with, we made $286 million. That's why we are at $264 million. And at least for this window of 20 years, that bottom line just shows you the cash flow line. So if we had made zero money in this entire period, the fund would have run out of money in 2022. But because we have an asset allocation, which is reasonable, nothing overly aggressive, we have been able to do well over this past couple of decades. The last page I'll probably touch on in this report is page 12 because it decomposes what we saw a moment ago in the performance summary page and puts names to all of the components. So what I mean by that is that first row is the same, but then now we see that large cap and mid cap are index funds with Fidelity and Rumline respectively. Then you have small cap with Wellington. Hardman Johnston is your international manager. We have 3 bites at the apple with real estate, Intercontinental, Madison 3, Madison 5. FIA is a timber manager, and then 2 managers with fixed income, Goodwin and Aetna. So what you'll see is that these managers don't necessarily beat every single quarter, but the mix is what drives the performance. And over the long term, the managers have done a good job. Any managers that haven't done a good job, what we've done is we've terminated them, and frankly, it's been on the stock side. We just move them to either index funds or managers that have paid for themselves with their keep by outperforming. So, yes.
David, our real estate investments, are they oriented toward commercial or
So-
residential or what? What's the mix there? And given your view of the market, are we positioned right or what have you?
So when we talk to the real estate managers on the institutional level, what they're all saying now is that they really feel like this year is probably the turn of real estate, fortunately now, for institutional quality real estate. So as I might have mentioned to you in the past, the basic 4 food groups of institutional real estate is apartments, industrials, office, retail. But now more managers also have some self-storage exposure, medical offices, hotels. Our biggest exposure in our portfolio is residential, so multi-family apartments, which is a good place to be. Then our next exposure would be office to a lower extent and retail. So most of our exposure is just in the four basic food groups, the greatest being apartments. I think what we have is a reasonable blend. Madison actually has more debt than they do equity, so that's been more of a constant type of return. Madison 3 is off a little bit just because the underlying real estate that they had lent to has gone down, but the debt actually is still performing at about 6 to 7%. So we intentionally combined our real estate to be a little bit more conservative by having just debt orientation and a portion being core plus, which is what Intercontinental is. So comfortable with what we have for real estate. Aren't necessarily recommending right now for more, but at some point we might, because it feels like we are at the tail end of the most recent cycle. Yes.
In commercial real estate, what do you see as the solution to bringing people back into the office? I would think that's a significant. No, but I'm just saying, that's a significant,
Sure.
you talk that they're gonna swing out of it.
That's a fair question, because we asked the same thing for the money managers, right? The real estate managers. And honestly, no one has an answer. Because what you are seeing.
So there is no answer in this context.
Correct. But the positive, because I always try to put a positive spin on things, because otherwise you're going to be a very sad person. The prices have already been slashed for office by about 50%, because the valuations have come down, because office buildings just aren't used the same way. Many places are either shadow vacant or vacant to about 30% or so. That's a reasonable level. What you have seen at the fringes, even in New York City, for instance, is a conversion of office to other types of building. Primarily, number one is residential. The problem with that, though, is that it's not easy, right? Because offices, as you know, are these big, vast buildings that you have to cut up into residential apartments. Never mind the zoning, but you literally have to then cut up all the buildings and then put plumbing in. So there's a lot that gets involved with converting them. There's no easy solution. They're working through that right now. What they just say is that, listen, our valuations are at a nadir in terms of office. At some point, it should turn around, because offices are not going to just close shop. You still will need offices. I know it's not an easy answer, easy
I
solution.
mean,
but-
Hartford's, we're looking at 27% vacancy rate, and 4 or 5 of our major double A are in foreclosure.
Yeah.
So, I mean, it's, in New York, it makes that look like a twerp in terms of what their problem.
Buddy?
Chairman, I think for the MPC, and then Scott can explain this or correct me if I'm wrong, but we never really closed the MDC. I mean, we didn't have public meetings and stuff, but our employees have continued to work through COVID, and we didn't really close the MDC down. And so I think that there are a number of entities out there, both public and private, that haven't or have or closed and have gone back into to work, and here in Hartford, notably Travelers is is back again. I don't know, but I think real estate's always going to be part of a portfolio. I mean, I think the only change would be how big a portion of the portfolio it occupies. But it's always going to be part of it because it's of the nature of it as an investment. It's still there. It may not be as good right now as it was 10 years ago, but it's still going to be part of it. I just took a quick question for you about the fixed investments. So what are those? And just so that we can explain it, and maybe I can use it myself to try to help my IRA. So be careful.
Yeah, I think the easiest way for me to answer that question relative to your own investments is these investments are obviously a little bit different because they're institutional. Right now, short-term interest rates are so good that you could just put into a T-bill or money market
got
and you're
that.
good.
Yep,
That'll give you
absolutely.
4 or 5%, you're good.
Already did that.
Perfect. Then you're doing the right thing. Now, relative to our fixed income investments, we have two bites at the apple here. Aetna actually is a product that's not available anymore. It's kind of a guaranteed investment contract. And what that essentially means that Aetna is going to give you a certain return, whether it's 4%, 5%, that's their guarantee. If they make more money than that, then they keep it. But that's how that product works versus what Goodwin does is they invest in different types of bonds. The majority of those bonds are government bonds. And then they do have corporate bonds, asset-backed securities, mortgages. But that's what the overall fixed income market is. The greatest share of the fixed income market is from bonds. Most of the managers do just look at domestic. With Goodwin, we're only looking at domestic. We're not looking at non-US bonds. On the government side, and then you have, as I mentioned to you, the other types of bonds. But those are the asset classes for the bonds.
Thank you.
Welcome.
Appreciate that.
Does anyone have any more questions with regards to our pension plan?
I promise the OPEB is a lot shorter.
To make the switch.
So if I may ask you to flip to the OPEB book, and it's a lot more streamlined because we're not looking at as much money and we're looking at something that needs to be a little bit more liquid. So if you flip to page 7 for me, despite those constraints, the portfolio did quite well by generating a 1.8% return for the quarter in the 11th percentile. If you look over the trailing year, we're at 10.8, 51st percentile. The longer term numbers are a little bit softer, but they still are actually ranking quite nicely. 3 years, 3.5, and then since March of 21, because as you may recall, the OPEB fund was only recently funded to a certain level. Before then, we didn't have an asset allocation. It was just really more cash. That was 5.3%. If you look at the asset allocation on the right-hand side, you see that roughly about 45% is large cap, about 12% mid cap, and then you have 6% small cap, about 10% international. The rest in fixed income or cash. When you add up the number here, it looks pretty high in stocks, but you may remember we actually have another couple of million in the sidelines in cash that we don't include in the book because it's not part of the portfolio here, but that's also additional fixed income money, if you will, that we have. So that's why the allocation is a little bit more equity heavy here. But what I will say also is that the vast majority of the exposure is indexed. If you look at the bottom right-hand corner of the page, you'll notice that we did have some withdrawals here, which is why the funds moved from $19 million to $19 million to about $16.5 million. And the last page I'll touch on just to keep this meeting moving is page 10. You see that the equity is all with Fidelity, so that's all index funds. Now, we had international that was active, and even that now is just index funds with Fidelity. And then on the bond side, we just have Vanguard, which is an index fund. So everything matches on the top row to the blue line because the actual manager is an index fund manager, and we would expect the numbers to be similar, very close. So OPEB's easy, pretty straightforward, nothing complicated there. Good diversified portfolio though, so that over the long term, hopefully it rises as well. Any questions?
Any questions for David? As usual, thank you.
Great, thank you very much.
Thank you, Dave.
Moving to, unless there are any questions, we'll move to item 6 on the agenda. Report by USI Insurance Services.
Yeah, Mr. Chairman and Commissioners, tonight we have Freddie Daniels and Bob Webb here from USI Consulting Group. You may remember Chris Monroe, he's USI Insurance Consulting, but we engaged USI Consulting Group to be our actuary last year. So this is their first presentation to you. They're replacing Milliman. And so tonight, what you're going to see is a comparison for first the pension, what the impact is to our total liability, and how much we have to contribute in 2025 for two different interest rates. And we're looking to you tonight to approve what interest rate we go with. And then we're going to do the same format for OPEB following that. But the actuaries will come and speak to how they arrived at the total liability, and then explain each of the alternatives for your approval tonight. When you approve the discount rate, it's going to tell me how much to put in for next year's budget that I first bring to Kelly, and then we bring to Scott, and then Scott's recommendation to the Finance Committee, and then ultimately the board. Okay, so, yes.
Bob, a quick question for you. I know that we have had a long discussion about moving the discount rate. Where are we right now in terms of, where are we at this point in time?
Okay, well, we'll go right to it. We're at 6 5/8. We've moved down in 1/8. We stayed the same in 2024 as we were in 2023, based on Milliman's projection. We had been moving down in 1/8, and I think you'll remember when I first got here in 2021, there were calls to drop it all the way to 6%. You lower the discount rate and your liability goes sky high, and then you have to contribute more to pay for that increased liability. My approach was, this is a long-term liability. Let's take it in small pieces and reevaluate each year. If it's appropriate, we'll recommend that we keep going down. Well, lo and behold, changes in the economy, I think that conservative approach was prudent, because last year when Milliman presented, they said, I think you're good keeping it the same. My recommendation is we keep it at 6 5/8, and that is one of the alternatives that USI is going to show you today. But we also wanted to show you what the impact would be if we did go down to 6 1/2. If this body feels it wants to be more conservative, drop the discount rate to 6.5. It costs us more. We have to contribute more in the next year, but that's an alternative also. So that's what they'll be presenting tonight.
Well, and I take it that you will discuss with us what budgetary pressures this creates in terms of the incremental increase in the contribution that we have to make.
Yes,
We drop, okay, thank you.
yes, it's all there. Okay, Freddie? Okay.
Mr. Chairman, do we have a hard copy of this report?
I don't think so.
We have some copies.
We have some, okay.
Are both of them front and
Yeah.
back? Oh, great, okay.
Yeah,
Be sure to turn to the pension side, because we're going to cover pension first. They should be marked at the top.
Retirement plan on the front.
Yeah, Bob, before you leave, I just wanted to, I asked the chairman if I can ask. So
Sure.
I know you said that in discussing the rate, that there were calls to lower the rate, and that but as I remember I'm not disputing that there were, but there were like perhaps one or two. But there were also calls to be as conservative or even more conservative that you wanted being too. So I think there were people on both sides of that issue. We wound up being fortunate that we took a more conservative approach to it. And I would say that, with respect to trying to build that fund, and I hope that's what we're going to hear about, because that's not like our pension fund. We're not all the way there yet. We're still trying to build this fund. We've only had this for how long? 3 years? Three or 4 years?
21.
Yeah, 21 is when we started
So-
funding it, but
So that was the point, to try to, for me anyways, to be conservative and try to build it so that, we can rely on it, and we don't have the sort of big crashes from, here, there, and every year up and down. And I think it was you that told us that basically, the responsibility we take on, in other words, the more conservative we are, the better the bond rating agencies, the better perspective the bond rating agencies have of us.
well, couple of things. Pension being our promises to the employees to pay them a pension, and OPEB, the second one, our promises to the employees to provide health care. So I think that the rating agencies respond to developing a plan, the plan that you all have approved, our incremental decrease in holding it flat, and then demonstrating the legislative will to implement that plan. I'll give you an example because I came from the municipal side. The city council members may say, oh, we don't want to raise the taxes so much, so let's lower our expenses. How do you lower your contribution for pension? You increase the discount rate. They have the opposite impact. You decrease it, liability goes up, you pay more. You increase the discount rate, liability goes down, and you pay less. And so that's the legislative discipline that the MDC has shown all these years, is that they address the calls for a lower discount, and we've been going down. But now there's a point where we feel that it's not necessary to lower the rate, and we actually, for 2 years in a row, we've stayed at 6 5/8. But we have the experts here to tell you the trends in the industry and all, and I'll turn it over to Freddie if you're ready.
But one quick question for you. Do we have to move lockstep with regard to OPEB and I'm going to call it our general pension plan in terms of the discount rate?
Well, we don't, but remember, these are incredibly long liabilities. Taking large steps in a single year is, conservative or liberal. It's not necessary, because what the actuaries do is they tell us the ADEC, the actuarially determined contribution. As long as we're funding that ADEC at 100% every year, that's why we pay them. They'll say, if you fund that ADEC at 100%, the assets are going to be available when the liabilities come due. And so I know, as you said, we just started funding OPEB a few years ago, and we're at 8-point-some-odd% funded, whereas the pension plan is in the 70% funded. But the funding level doesn't make a whole lot of difference. Putting in a ton of money to make it 100% funded is simply unnecessary. What's necessary in my mind, and I think prudent in rating agencies and other agencies that look at us, is making sure you're fully funding that ADEC, because that's what the actuaries are telling us. If you put it in, you're guaranteed, as much as you can guarantee, you're guaranteeing that the assets are going to be available when the liabilities come due.
Okay, I guess, but my question is, right now, the discount rate is what, 6.5 of discount to?
6 5/8, I believe,
6
right?
5/8.
Yeah.
And that's for both OPEB and for, what I'm asking basically is, could we have different discount rates?
You certainly could, but the choice of a discount rate is to address a liability, and both liabilities are very long-term liabilities. So there's a case to be made for them being the same, but they don't have to be, just as you said.
That's all I wanted to ask.
Okay.
Thank you.
Cool, thanks.
Thank you, Bob. And thank you, everyone, for having me here today. It's nice to meet all of you or see your faces in person. I'm Frederica Daniels. I go by Freddie. And today I'll be presenting information related to the pension plan, and then my associate Bob will be going over the OPEB plan information. So in front of you, I think you all grabbed a hard copy of the chart, and I'll be going over 3 topics for this chart. First, I'll do a quick level review of some of the numbers that were produced from last year's valuation, because they're important for this year's contribution level. Secondly, I will talk to you about the valuation that my team produced this year, which will set your contribution levels for the next year. And then thirdly, I'd like to point out to you some sensitivity analysis we ran specifically having to do with that discount rate topic that Bob just talked about. So hopefully we'll get to all 3 topics and I'll be able to answer your questions. I'd be happy to answer them as they come, but if you give me a moment, I'll give you some high-level results from the past year or so. So if that works, I'll start off just as a reminder in that first column. It's labeled the 23 valuation, and that was last year's report, which was completed to set your contribution level for this year. And if you look at row 6, that's bolded, it reiterates that the contribution level was just over $9 million. And that is what Bob has been used to budget for the contribution level for 2024. So what my team did is now in our first year of hire, and just to kind of help bridge the gap, what we did is we took the information from the prior year that was produced by a prior actuary, and we actually replicated all of the results, and were required by pension law to do so and to be very particular in matching the information to be within a percentage point or 2. And the great news is we were able to replicate everything from the prior year. And then what we did is we collected information that occurred for compensation and census changes and other demographic updates throughout 23. And then we reran the valuation as of 1/1/24. And the importance of that process is to set the contribution level for 2025. And those are the results you'll see in the second column. Highlighted in the red box will show you the increase. Last year's results to this year's results show an increase of about $800,000 in the recommended contribution, or abbreviated as ADC, which is the actuarially determined contribution. Now, the $800,000 increase comes from basically 3 factors. You have a group of active employees working, and each year that they work, they generate new costs, new benefits, right? Their years of service increase, and their compensation generally increases. So those 2 items factored together allows them to earn a new benefit, and that cost of that benefit accruing is factored into your contribution. And the increase year over year from last year to this year was an additional $200,000. That's part of the $800,000, or somewhere around $200,000 to $300,000 in cost. Then the second part of your contribution level is looking at what is your outstanding liability. So we measure everybody's benefits today. We use a group of assumptions, and we come up with a present value. Like, what is the obligation today? That obligation is compared to your assets. And that net difference is called the unfunded liability. And as Bob mentioned, the obligation to fund this pension plan is not a short-term vehicle. It is definitely a long-term vehicle. So we amortize the unfunded liability over a period. And there's a policy in place. About 7 years ago, that policy was reset at 22 years. So we've been ratcheting down 1 year each year. So in 2024, we're at about a 15-year period. So we look at that unfunded liability, and that amount is amortized over the next 15 years. So when we look at that amortization, we looked at any gains or losses this year that increased or decreased last year's unfunded amount, and they were incorporated into this year's amortization payment. Think of it about like a loan payment, like a mortgage. Generally, your mortgage would stay constant year after year if nothing changed, but you have a moving target. You have participants coming into the plan, you have participants retiring, some terminate. And honestly, we do our best. We don't have a crystal ball, but we definitely do our best to generate a set of assumptions that are both reasonable in the aggregate, but each assumption should also be individually reasonable. So when we compared the actual experience to the expectation, we were within about 1% of the expected liabilities, although there was a slight loss of a net $3 million. So when you amortize that net loss for the 1 year over the next 15-year period, that added about $300,000 to the contribution level. So if there were no gains or losses and everything was exactly as expected, and there were no new employees and nobody was earning a benefit, your contribution level would have been the same as last year. But again, the reality is people are living a little longer, they're working longer than expected sometimes. What we saw this past year, there was just a little bit of mortality loss experience. A few people did not pass as expected, and salaries were actually just a little bit higher than expected. So when you factor those experiences into the equation, that increased the amortization level about $300,000. And then the third piece is, by nature of your set of assumptions, the amortization isn't constant. Rather, it increases each year at what we call an amortization growth rate. And that assumption is about 3.5%. It's sort of a pay me now or pay you later type assumption. And as other costs increase each year, like inflation and salary increases at that 3.5% assumption, your amortization piece of that unfunded liability will also increase each year at that same amortization growth rate. So the amortization growth rate piece added about 300, the loss was about 300, and the normal cost was about 200. So when you add those three factors together, sorry to be a little long-winded there, but I thought I'd give you a little bit of an education on just the differences of last year to this year. As Bob mentioned, I could break it down for you. But that is the increase. So if we keep all your assumptions the same, apples to apples, we still use a 3.5% inflation and in salary increase and growth rate. If we still use that 6 5/8 discount rate to value liabilities, you're going from a $9 million contribution level this year to an expectation of $9.8 million next year. And again, that's highlighted in row 7. You'll see the increase. We did take a look at one other item. As Bob mentioned, there may be discussion is to, if you want to lower the discount rate by another 1/8, what if you do go to 6.5%, down from the 6.625%? What impact, you might ask, does that have? Well, that's what we're showing in the third column on this chart. You'll notice in row 1, it increases your liabilities about 1.3%. So your plan has a duration of 10. That generally means every 1 full percentage point or 100 basis points that you change your liability rate, then your liability will increase about 10%. So at 1/8 of that, we're just about 1.3% increase in liability. If everything else stayed constant and we ran that increase in liability through all the formulas, we come up with a new actuarially determined contribution. And that would actually be 1.285, almost 1.3 million for the year. So instead of going up to 9.8, it would go up to 10.3. So bottom line, the impact on the budget would not just be that $800,000 increase, but almost another $500,000 increase to almost 1.3 in total. So again, in summary, if we leave all the assumptions the same, you're at an $800,000 increase for the year. If you decide to change the discount rate and drop it 1/8 of a point, you're going to have a total net increase of $1.3 million on the budget. And I'll just make one general comment about the discount rate. Generally, your discount rate is set equal to the expected return on the portfolio. And as the investment advisor just spoke about investments in general from this past quarter, but also gave you some statistics on the long term, is we did see that for just this past calendar year, you had about a 7% increase on the actuarial value of assets. The market return was almost 12%. But that's not always going to be the case. As we all know, unless you have that crystal ball yourself for your personal investments, we don't know exactly what the return will be year after year. But historically, over the past 20 years, we've seen that 7 to 8% return. So fine-tuning it that much to 6 5/8 versus 6.5 might be quite difficult. So sometimes what we do is we run projections, or we look at market indices. We have publicly available information. There was a recent public plan study of investment advisors, of over 40 advisors giving investment return feedback. And they ran stochastic projections and said, what's the likelihood? What's that 50th percentile of hitting 6.5 versus 6 5/8 return? And the interesting result was that it's almost less than a 1% differential of the probability of hitting that 50th percentile under both scenarios. A lot of it has to do with sometimes the timing of the market or the individual investment mix. And I should say, a lot of those returns I just mentioned were comparable to your current plan's investment mix. You have about 65% of your investments in equity, and about 35 in the fixed portfolio. And with a duration of this plan of about 10, and the payouts of at least another 75 to 100 years by the time your current active group retires, and then that retirement group collects all their benefits, you're looking at an apples to apples basis. And right now, a 6.5 versus 6 5/8 return, there's not that much difference in the probability or likelihood of hitting that return, or at least not now what's publicly available from historical returns, also factoring in the next year of outlook. And I think as Bob best said, this is a long-term investment vehicle, 20, 30 years. So I'm not saying that 1 year doesn't make a difference. It does. We can have another market crash, and 1 year could have a huge impact on your contribution levels. Or if you make an assumption change in that 1 year, as we see here, you might have a $500,000 impact on your budget. But the point is, setting this rate, it's not something that we want to set and forget, but it's not something that you also should feel obligated to change every single year. So I just ask you to keep that in mind when making a decision on whether or not to decrease your rate another 1/8 of a point or keep it the same. The outlook from last year to this year, given those public surveys, has not changed significantly from last year to this year. So whatever general basis you used last year in your discussions to keep it constant from 23 to 24, you may want to keep similar points in mind as to whether to change it from 24 to 25. And again, given that the outlook has not changed significantly, if anything, the fixed income has gone up a point or two in the expected returns, and certain equities have gone down a point or two, the net result is pretty constant. So I might have my own opinions on certain type of rates. I will share with you that I think it's reasonable to continue with this rate, but I'm not opposed to changing it. I think more of it is what is the impact on your budget, and is that sustainable for that increase for the next year? Because once you make that change, then I would imagine you'd have a hard time going backward or increase the rate unless something happened in the market to really generate a need to make a change even the following year to increase that rate. So it's not as if you're going to set it and forget it. I think a discussion that will probably ensue here today is very important, but just know that there could be pros and cons for both sides of those things. So I think I'll pause here to answer any questions.
I don't know if it's so much a question, just if you could just comment on it. So we're talking about if we went from the 6 5/8 to 6, it's 0.125% that we're talking about. If somebody were to change it, I just think that in a year where we produce a surplus, and we have the ability to keep it at 6.625. That we should, because I see that as an investment really in the future too, in a way. The dollar amount that we're putting in turns into a bigger dollar amount as time goes by. If we lower the dollar amount that we're putting in, it turn into a liability. It's not going to accumulate. It's going to accumulate the other way. So that's just the way that I see it. That's why I've always been more conservative about where we would go with this, particularly with the OPEB fund, because it's, like I said before, it's still kind of new. It's funded at 8%. I don't know whether that's, I don't know, but at any given time, like you said, if there's some sort of market crash or something, then then we have a different problem in making those payments, and those are payments that have to be made. Those are payments for medical services and OPEB that we have to pay now today. So that's all my comment. So I think I did get that right, didn't I, about that? So it's like an investment. It actually turns into more dollars than you put in.
I'll make a comment to your comment, if you don't mind. You mentioned a good fact that maybe I initially brought up about market volatility. There are additional policies in place in this plan, not just the black and white of these numbers that you see. I mentioned there's a bunch of assumptions, but there's also policies, or what we call cost methods. And the valuing of your assets of the plan that help generate these contribution levels is one of those policies. And we don't just use a mark-to-market change each year or to measure that volatility. We actually incorporate, or I should say you have had this funding policy in place for a while, an asset smoothing. So you take gains and losses in your investments and smooth them out over 5 years. In the last 4 to 5 years, you had 3 of the 4 years that we measure of gains and 1 year with a very large loss. And the interesting thing is that 1 year of losses is already higher than the cumulative amount of gains in those prior 3 to 4 years. But you are smoothing out, and you only recognize 20% at a time any given year's asset gains or losses. So the smoothing value of those market volatility changes is very helpful to the plan. So to the same point of the fact that we're smoothing out the investment gains and losses to help keep your what we call actuarial value of assets as consistent as possible, it's just one of those other methods that helps. So you have the discount rate and you have other assumptions, whether it's for mortality, turnover rates, retirement rates, the investment return, the salary scale increases. There's all these other assumptions that we put in place. And like I mentioned earlier, this year when you combine everything, there was less than a 1% net change or net loss compared to what was expected. And while you had a little bit of investment gain at that 7% actuarially compared to the 6.625%, so it generated about $1 million of actuarial gain. There was about 3 to 4 million of liability loss, mostly due to higher than expected salary increases. And as I mentioned, a few people retired a little earlier than expected, and there was some life expectancies that were longer than anticipated. But when you marry all those pieces together, it was a minimal, I won't call it a blip, a minimal change, right? Like a less than 1% net change. And then we amortize that piece out. So that piece is already built into your contribution level. And the fact that your amortization on the unfunded liability, like I mentioned, a mortgage would be pretty flat if you have a 15-year mortgage. This 15-year mortgage is what I'd consider almost like a variable mortgage. It's automatically going to go up every year by 3.5%. Because that's the amortization growth rate. So those two pieces alone are already built into your contribution level, and you're seeing increases in the last few years due to these items. So I just ask you to keep that in mind when factoring in another piece to change a different assumption, which is that discount rate, and how that might factor in. But to your point, and sorry for being a little long-winded, but hopefully I'm providing some positive and informative feedback, is that if you make the change now to that point, you will put more money in. So you might have a higher investment. So if you have a positive year, you're earning more money on that investment. But if you have a negative return year, you're sort of losing some of that investment too. So the table can go both ways.
Thank you. I appreciate your answer. Thanks. Thank you, Mr. Chairman.
Anyone else? Continue.
Before we leave, I think it's, I gave you a bad number. I said 8.8% for OPEB. It's actually 9.14%. But just so you could see the numbers, in the first column, the number one is the total liability for pensions, $329 million. And so that's today's dollars present value. And then line number two is just the value of the assets that we have in the bank, and that's $253 million. If you go down to row 10, you'll see if you say, hey, what are your assets divided by your liabilities? That's the 77.87%. So all of those liabilities, that long-term liability brought down to today's dollars, we have 77.8% of it already in assets. And so when Bob comes up, you'll see that same comparison, assets, liabilities, and I quoted 8.8. I think I had that. That must have been an old number, but it's actually now 9.14%. So.
And I actually just want to make one more comment, if you don't mind, on the pension. If you don't mind, from the visual, scrolling up just a little bit so you can see that bottom section of assumptions, even though you have a hard copy in front of you. I do want to mention this is more of a heads up for next year. We did look at all the assumptions, and as a new actuary, we look at everything with scrutiny, and we went through each piece. And like I mentioned earlier, I do believe and feel, as the signing actuary for this plan, that the assumptions are reasonable individually and in the aggregate. But there are a few items that we looked at. And there are some things on the side that my team did discuss with Bob, more just as a heads up. If we wanted to change, for example, that amortization growth rate for the future, if you wanted to make it more level. So instead of a pay less now or pay more later and have a 3.5% increasing assumption, we could look at making that level. But it's quite expensive to chew that all off at one point. Another thing we looked at is the mortality improvement scale. And I mentioned this year that mortality was pretty much on par. But every year, the retirement plan experience committee from the Society of Actuaries will come out with what they call mortality improvement scales. Another way of saying the outlook on life isn't stagnant. So mortality expectations or life expectancy increases have been changing every few years. I think it goes back all the way to 2017 and 18 and 19 and 20, 21. We saw new mortality improvement scales released every year by the Society of Actuaries. But since COVID, that committee has basically made comments that not enough information was available or it's not as credible to come out with a new scale for 22 and 23. And I don't quite think we're going to get a new scale in the next few months for 24. But as a heads up, you may see a new mortality improvement scale issued in 25 or even in 26. So we went ahead and measured what type of impact might that have on your plan. So again, just keep in mind as a heads up in the next year or two, you will be facing potentially another decision point to adopt the next scale that is released. And we would make a recommendation that you use the most current scale as they are released. And generally, I did mention this is going back towards 2017-18. Each year, when the Society of Actuaries came out with these new tables, we were seeing about anywhere between 0.5% to 1.5% to 2% of increases in liabilities. So if you remembered earlier, I was talking about other assumptions that might impact your liability. A change in the mortality outlook, if it increases your liability about 1%, you're talking about another $3.4 million of increased liability. So if you amortize that over 15 years, that also is another $300,000 that you would see as an increase in your contribution level. So again, more just of a heads up for the next year to two, you're automatically going to see increases in the budget number for the 3.5% on the amortization growth. If you have more employees than expected, you're going to see some increases due to those new benefits they're earning. And you're going to face an increase for the mortality improvement scale. So just items that will factor in. So I don't have a crystal ball. I can't promise next year's level will be flat or just a little bit higher than it is this year, but heads up that there will be some new items causing pressure that will probably have an upward impact on your ADC. So if you keep that in mind when discussing your budgetary levels for this year, that might be helpful. Okay.
I guess my question for you in that regard is that, is it prudent for us to give careful thought to looking at any surplus that we may have to essentially reserve that for perhaps a lump sum contribution to try to smooth that out if the assumptions change with regard to the mortality tables?
When you say surplus, do you mean budget surplus?
No, I'm talking about surplus with regard to our revenues. In other words, that essentially if we budget, let's say we budgeted $100 million, and it winds up at the end of the year that we only spent 85. Well, we've got 15. I'm going to call that surplus, and I'm simplifying it considerably. You have to make some decision as to what you're going to do with that surplus. One of the things that we could think about is making a determination with your assistance whether or not we should put a lump sum into the pension plan if that mortality table changes and we have to then have an incremental increase, say like $300,000 a year. Can we do some kind of calculation where we can make a determination to lower that by just making the upfront payment in real dollars?
We can look at that. That's something that I'd be happy to talk with Bob about, especially towards the end of this year. Historically, we've seen new tables, if there are going to be changes to the mortality improvement scales, late fall, usually that November area right before year end. The auditors love and want us to always capture those increases very much so at the very end of the year. So that's generally where we see the experience. So as we head into the fall over the next few months, if there is a release at the end of this year, we absolutely will run some numbers and work with Bob. But just using the historical values from the last handful of years, I went ahead and actually ran one of those projections already to give you that idea. So that 300,000 might be a reasonable number for you to keep in your head or for discussion purposes as a budgetary item for that surplus. Yes, so I think it's very practical to consider keeping in mind the value of that type of increase, just like I'd say keep in mind the value the other $500,000 that you'd use from the budget if you make a change for your discount rate. So I could present anything you need me to this committee, but also work one-on-one with Bob and give him any information if you have additional questions after this meeting that funnel through.
Well, I think basically this is a presentation for discussion. We're not going to be taking any action, so that we will have to revisit this, Bob, at some later point in time, or are you looking for
Well,
some
I
specific
was
action on our
hoping
part?
to get a vote this evening on the discount rate because it's already August and we have to come before you with a recommended budget in September. So we were hoping to get that decision so that I could put it into the budget. Freddie mentioned that we've had these conversations back and forth, and knowing that the mortality tables come out every 3 years, there's going to be a new one. The preliminary calculation she did said it may increase our liability by $3.5 million. When you amortize over 15 years, that's roughly $300,000 impact to our contribution in the next year. I think it's perfectly okay to wait for the mortality table to come out and utilize any surplus that we have to address it at that point. And we can do it as we've done it before, is that we do a contribution from the surplus or the fund balance on the sewer side, net position on the water side, so that the member towns don't have to pay for that increased contribution for pension, and the ratepayers don't have to pay for that increased contribution for pension and OPEB because we're leaving the surplus in fund balance or net position, and when we determine what that increase is, we bring it up into the budget. That's that line, contribution from funds in the budget. But as soon as they get the new mortality table, she's committed to work with me, tell me what the impact is, and I will bring it to you immediately via email so you can consider it. And then maybe make an adjustment later in the budget process. But if possible, we'd love to get a decision from you tonight for the discount rate. So at least we have a starting point for the September budget.
I guess I'd have to ask the delegation. This is the kind of thing that I guess I'm more comfortable if we have an opportunity to kick this around and to discuss this in some detail. Now, that may mean that we'd have to schedule a special meeting, but I guess, I will defer to the group in terms of your thinking. But I would like for us basically to maybe have a chance to discuss this and look at this, because there's a lot of moving parts here. And I'm just concerned that we get it as right as we possibly can. So I guess, Mr. Drake?
To be honest with you, the discount rate is just a guess at everybody's part, what it really is. To me, we just leave it the same what it is. I mean, 1/8 difference doesn't make much difference. So we're happy with what we have, just leave it the way we are. I mean, it's not a lot of science here behind it. You just take the shot at it, right?
It's the best
It's the
information
best,
we have.
and that's all you have. So that's, to me, we're happy with what we have. I'd vote to say, let's keep going the way we are at 6.5.28, or whatever that number is. I don't know what it was, 6.5 something. So that's my opinion.
Mr. Curry?
Thank you, Mr. Chairman. Commissioner Curry, there's a lot of moving parts, and besides the discount rate, you've got the amortization growth rate, the mortality table, and I cannot recall any year where a newly adopted mortality table didn't have a negative impact on our budget. And I've known some towns who put off the inevitable for 10 or more years before they adopted a new mortality rate because they were told they finally had to, and it was catastrophic for them. But the discount rate, and you all know my position on the discount rate, and Bobby, this one's for you. I had some concerns last year with keeping it the same. I was a bit uncomfortable, although I understood why. This year, I think with the presentation and the numbers and all the moving parts that we have now, I'm okay with keeping it the same this year. And I don't disagree with you that we have other things that we need to talk about. I don't think it would necessarily be a special meeting if we approve the discount rate tonight, but the other variables that we can address that will have, if we address it, most likely will have a negative impact on our budget, but may be beneficial in the long term for the plan. So with that, without objection, I would move that we set the discount rate this year for the 6.625%.
Second.
Do we have somebody? Mr. Chairman, I would, based on the presentation that we have and my understanding that, I think that I would support, keeping it at, 6.625%. And also, it's the combination of that and the contribution of what, 300, how much, what, 300,000? I think that it's already programmed in that we increase each year. You say, you mentioned that, if you could just say that again, that's our protection, I guess, against this, the mortality rates changing and going up and forward. But if anybody needs to hear that again, so to me, it's both. It's the 6.625 and the contribution going up. So, which I think is very conservative, but it worked for us, and I'd like to see it keep working for us.
So I understand the consensus. There has been a motion, I believe, and it was seconded, that we hold the discount rate at its current level. And that would apply to both the pension plan and to OPEB. Is that correct?
We haven't presented the OPEB yet, so that's
Well,
the next
but-
presentation.
I'll be happy to make that motion when the time comes, though.
Okay, all right. Thank you.
Thank you.
Well, then we should,
Bob Webb will speak to the OPEB.
okay, but we have a motion on the floor. So I guess my question is, all those in favor?
Aye.
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 Opposed? Motion passes. Thank you. We're ready for the next, for OPEB.
Thank you. I'm Bob Webb, and I'm one of the actuaries that works on the OPEB plan. You'll want to be looking at the side that says other post-employment benefits. Numbers are a little bit lower. Pretty much everything that Freddie described, the methodologies, the concepts that apply to the pension plan, apply the same way to the OPEB plan. The way that we do the valuations and come up with our numbers. Obviously, we're valuing a different set of benefits. And the one thing that probably differs pension from retired medical is the healthcare trend assumption, which is a major assumption. And I bring that up. We do the val on OPEB usually once every 2 years. And then the second year is a roll forward of the first valuation. The assets get updated every year, but the liabilities tend to stick with the same assumptions and based on the same census in the first and second year. When Millman was doing their 1/122 contribution calculations, they had a liability of about $120 million as of 1/122. But as of 1/123, they changed their healthcare trend assumption and increased it, I wouldn't say significantly, but they strengthened the assumption. It was a little weak. It was a good move, I think. And that upped the liability by $14 million, but they did not apply it in determining the contribution. They just applied it in developing the expense liabilities. So when you look at this number here, you see when we, on the top line, when we go from the prior year contribution to the current year, it's about a $15 million increase. And most of that's due to that assumption change. Otherwise, we're using all the assumptions that they used as of the end of 2024, 2023, I should say. And really, there's not much else to discuss there. We thought their assumptions were reasonable. We didn't see any reason to change them at this point. Obviously, we'll be looking at them again at the end of the fiscal year. Don't expect we'll likely change them, but that's open to discussion at that time. And you can see that, so there is that big increase in the contribution going from the 2024 to 2025. But you can see the 6.5% assumption doesn't really have a huge impact on the OPEB numbers. There's sort of offsetting entries there that make that happen. So that's, I could repeat everything Freddie said, but I'm not going to. But if you have any questions, I'll be happy to answer.
Does anyone have any questions? I take it that we would entertain your motion with regard to OPEB.
I'll make the motion that discount rate remain the same.
Do I have a second on that?
Second.
Okay. All those in favor?
Aye.
Aye.
Thank you very much. That passes. Thank you, Bob.
Yeah, thank you.
Move to item 7, discussion of the history of retiree pension cost of living adjustments.
Mr. Chairman, because of time commitments, can we move this to a future agenda? And I'd ask that we also be provided with that agenda with the history of what we've done at the last adjustment.
So no reason to object. Does anyone on the committee object? Do we need a formal action on moving that to another agenda? Okay, all right then. All right, then item 7 will be moved to another agenda. We can go to item 8.
Good evening, Commissioners. Jamie Harlow, Director of Human Resources. The monthly employment actions report for the month of July is we had one retirement, a 24-year employee from the local 184, and we had one resignation, an individual that was within his probationary period from 184 also.
Thank you.
Thank you.
Thank you.
Thank you, Bob.
Thank you very much. Anything else? Any questions? We will move to, Jamie, is that, you finished or?
I'm finished, yes,
Okay.
Commissioner.
Then we'll move to item 9, opportunity for general public comments. Once again, any general public comments? Item 10, commissioner requests for future agenda items.
Just that we put that back on the next agenda
Yes.
item, number 7 back on.
Curry?
Thank you, Mr. Chairman, Commissioner Curry. On this agenda, number 8, can we also put on for the next agenda, the report to include promotions made, new hires, and what the classifications were, and the process used for those new hires, whether it was internal, external, posting, et cetera, and then number of vacancies.
Yeah, that,
And I know all that is in Scott's monthly report, but it's buried in there in the 45 pages, and it's just easier, I think, for us to get it from Jamie.
all right. Anything else? I will entertain the appropriate motion.
So moved.
Can we get